Hello and welcome to the fourth quarterly webinar hosted by Tacit Investment Management. My name is Raj Basra and I am the Chief Investment over here at the firm. And I will, over the next half an hour or so, try to give you an idea of a reminder of how we manage money, the ethos of the firm, and some of our current thinking and some of the changes that we've implemented in portfolios and strategies over the past month or so. Looking forward. So on this slide, you'll see the key tenets about the firm. We are an owner-managed business, which has been running, we're into our 14th year now. We invest primarily for UK investors, i.e. UK clients who are either based here or based abroad, but ultimately aim to have sterling as their base currency. And we find that sets us apart from most in a more and more globalized industry. We're an experienced team, as you will have seen from the first slide. Most of the team have over 30 years experience on average, and we are a very experienced team that have seen many ups and downs and invested through many difficult periods as well as strong periods. We have a simple and coherent investment philosophy which is focused purely on generating inflation adjusted returns after charges for our clients. That sometimes means that we look at investments that others wouldn't look at, and sometimes means we do stand out from the crowd in the way we're aiming to achieve returns. But ultimately, we are here to generate inflation adjusted returns over the medium term for our clients. It's not from year to year, and that's very focused at the moment because of inflation having been where it has been. But we do believe our strategies are set up to generate above inflation returns over the medium term if held for long enough. Here are our core foundation strategies, as we like to call them. We have four, going from the conservative all the way out to the total return. You'll see that they go up in 25% increments for risk growth assets. And ultimately, on the right-hand side, the total return is our riskiest strategy. On the left-hand side, conservative is our least risky strategy. And their objectives primarily are to preserve nominal value, to preserve the real value of assets over time. The real return is where clients generally draw income from, and we are aiming to preserve the real value of the remaining investments. Steady growth is to try and grow the real value of investments over time. Sounds simple enough, but actually it's interesting how many people forget that real returns are what matters and not nominal returns. For those who don't understand what I mean by that, in simple terms, if inflation is running at 5% and you are generating a return of 5%, in real terms, you have not grown your assets. If inflation is running at 10 and your nominal return is 10, again, you have not generated any returns on your assets in real terms. If inflation is running at 3 and you generate 5, that is actually better than inflation running at 6 and you generating 7. Here are the 12-month returns of our strategies going to the end of October, which we do at every webinar. These are rolling numbers, so it's important to note that we are not always going to be ahead of the peer group. But again, this shows relatively strong performance when compared to the peer group over the last 12 months in rising markets, albeit marginally. These are the longer term numbers for our strategies. Annualized returns since inception, you can see on the left-hand side for each of the strategies. And what you can also see on the right hand side there is a ratio we like to look at, which is the MAR ratio, which basically says for every unit of downside risk we take on for our clients, i.e. when markets fall by 5, if we fall by 5, what happens if we then markets rise? Do we rise by more or do we rise by less? So do we take on the same risk on the downside and then rise by more or by less, or do we take on less downside risk and then also rise by more? Our strategies tend to fall by less than the peer group, but then also rise by more than the peer group because of our unique way of actually constructing portfolios and very focused way of constructing portfolios. You can see that best here in the conservative and the total return strategies, which show significant outperformance on this ratio compared to the peer groups. And it's very important because we've spent a long time over the last few years focusing on preserving values. Things are expensive. We now move into a new world in our view, or back to the old world of 15 years ago, where there are lots of opportunities, and that's why we've titled the webinar Looking Forward to Opportunities rather than Trying to Preserve. A reminder of why our strategies behave like that. We split our portfolios into two components, a growth component and a stabilizer component. We are very strict in what we put into the stabilizer component because those assets are there to preserve value and to mitigate downside volatility when things go wrong. An example on the right hand side here is the US inflation-linked bonds, which we believe are a very strong stabilizer and risk diversifier in UK client portfolios. And you can see here that when equity markets fall, these bonds go up normally in most scenarios, not in every scenario, but in most. And when equity markets go up, they do have an intrinsic value to them, so they do trend up as well. So you're not paying for an insurance that doesn't have an underlying value as you would be by buying options or options on the market, for example, to protect yourself. It's very important to bear that in mind. And then we have the growth components, which we are unconstrained. We can buy anything we believe will generate the returns that our clients expect us to generate and should receive over the medium term.